Welcome to the Explainer. Okay, let's dive into this, because today we are demystifying something you absolutely know you need, but let's be real, very few of us actually understand. We are talking about health insurance in India. We're going to break down the definitive guide for 2025 and 2026, cutting straight through all that confusing jargon and showing you exactly how to protect your finances and, of course, your family's health.
We've got to start with a pretty terrifying reality check. A massive 60% of healthcare expenses in India still come right out of our own pockets. Seriously, 60%. Despite all the amazing advancements in modern healthcare, if a medical emergency strikes, the vast majority of that financial burden is still falling squarely on your shoulders. And those are incredibly high stakes for any household. And the situation gets even more urgent when you factor in this number: 12 to 15%. That right there is the current annual rate of medical inflation in India. To put that into perspective, the sheer cost of treatments, room rates, surgeries, and medicines is literally doubling every 5 to 6 years. So if you're just relying on your bank savings to cover a potential hospital trip, you're fighting a losing battle. Your savings simply cannot grow fast enough to keep up with these skyrocketing costs. But hey, don't panic, because here is our exact roadmap to fix that. We'll be covering the true cost of getting sick, whether your corporate cover is actually enough, decoding that tricky health insurance jargon, tax perks and bonuses, and finally, your very own step-by-step buying playbook. Let's get right into Section 1, the cost of getting sick and why you desperately need financial armor.
You really have to start thinking of a policy not as some annoying monthly expense, but as essential financial armor. It's built to protect your life savings from a single catastrophic event. And when you secure a solid contract with an IRDAI-regulated insurer, here's what that armor actually pays for. It is so much more than just a hospital bed. A good policy covers room rent, nursing staff, those extremely expensive surgeon and consultant fees, diagnostics, and even daycare procedures that don't actually require an overnight stay. But crucially, this also includes pre- and post-hospitalization costs. We're talking about covering doctor visits and tests up to 30 days before you're formally admitted, and paying for your medications for up to 60 days after you're discharged. That is absolutely massive for protecting your wallet. Moving into Section 2. Is corporate cover enough? The false umbrella. Look, corporate cover keeps you nice and dry, but only until you leave the building. So many of us feel completely secure just because our employer provides a group health plan. But we need to look at the severe limitations here. This cover is entirely temporary. The second you change jobs, get laid off, or retire, poof, the coverage vanishes. Plus, corporate policies usually feature significantly lower sums insured, hidden exclusions, and strict sublimits on what they'll actually pay for. Relying entirely on your employer's plan leaves you and your family dangerously exposed, especially when you might be transitioning between jobs and at your absolute most vulnerable. You absolutely need your own personal backup. Section 3. Decoding health insurance jargon, your cheat codes. Okay, we're going to rapid fire through the industry terms that trip most people up so you can navigate this market like an absolute pro. Let's start with PD, or pre-existing diseases. This just refers to any medical condition like diabetes, hypertension, maybe a thyroid issue that was diagnosed or treated before you bought your policy. Now, the fantastic news here is that the IRDAI has recently stepped in and reduced the maximum waiting period for these conditions. It used to be up to 4 years, but now it's firmly capped at a maximum of 36 months, or 3 years. Next up is the restoration benefit. Honestly, think of this as a magic refill for your coverage. If you happen to exhaust your total sum insured during the year because of a major claim, this feature automatically restores your balance. It is an absolute lifesaver if, heaven forbid, there are multiple hospitalizations in your family within a single year. And get this, some modern plans will even offer you unlimited restoration. Then we have NCB, the no claim bonus. This is exactly how the insurer rewards your healthy years. For every single year you don't make a claim, they boost your total coverage for free. Sometimes they increase your total sum insured by 100 to 200% over a few years. And some fantastic plans will even grant you this bonus if you only make a minor partial claim. And this brilliantly illustrates the big choice you have to make when structuring your plan: family floater versus individual plans. A family floater pools one large sum insured for your entire family to share. It's highly cost-effective and perfect for young, relatively healthy families. An individual plan, however, gives everyone their own separate pot of money.
This is much better for seniors or families where one person has a chronic illness. It just ensures they don't accidentally exhaust the coverage limit for everyone else in the house.
Next, top-up versus super top-up. This difference is absolutely critical. Both are ways to get massive extra coverage for a cheap premium by taking on a deductible. But a standard top-up only kicks in if a single hospital bill crosses that deductible. A super top-up, on the other hand, looks at your cumulative bills over the whole policy year. If multiple smaller bills finally cross the deductible amount together, the super top-up activates. Let me tell you, the super top-up is the ultimate flexible hack for securing massive coverage without breaking the bank. Let's look at Section 4, tax perks and bonuses under Section 80D. Because protecting your health should absolutely also protect your income, Section 80D is your best friend under the old tax regime. Check this out. If you're paying premiums for yourself and your family, you can deduct up to 25,000 rupees. If you add in premiums for your senior citizen parents, that's an additional 50,000 rupees. With the right family structure, you can claim up to 1 lakh rupees in total tax deductions. Plus, you can actually carve out 5,000 rupees from these limits specifically to pay for preventative health checkups. So you're quite literally saving tax money by going to the doctor to make sure you're healthy. How great is that? Finally, Section 5, your buying playbook and taking action. Theory is wonderful, but now it's time for a direct, actionable roadmap to secure the exact right policy for your life. The first question everyone immediately asks is, how much cover do I actually need? Well, the general rule of thumb is 10 to 15 times your annual income. But let's anchor this to a real scenario. If you're a family of 4 living in a metro city where healthcare costs are incredibly inflated, you really need to aim for a 1 crore plus total cover. Now, I know, that sounds wildly expensive, but remember that hack we just talked about? You achieve that 1 crore simply by buying a modest space policy and layering a highly affordable super top-up directly on top of it. Before you pull the trigger, here is your exact checklist. You must compare the sum insured, features like restoration and NCB, the network hospitals near your home, and those sneaky waiting periods. And please, listen carefully to this part. Do not just blindly buy the cheapest policy on the market. The absolute cheapest plans are where you find nasty surprises, like room rent capping. That can end up reducing your entire claim payout drastically, just because you picked the wrong room category. So, the crucial point is reliability. You need an insurer who will actually pay out without a fight when you're in a crisis. Look for a claims settlement ratio, or CSR, greater than 95%. That is the absolute gold standard for reliability. For example, recent data points to companies like New India at nearly 99% or HDFC Ergo at around 97%. Securing a CSR above 95 means securing true peace of mind. You also want to quickly glance at the incurred claim ratio, or ICR. This metric tells you how much of the premium collected is actually being paid out as claims to customers. The sweet spot you want to aim for is 70 to 90%. If it's too low, like under 60%, it indicates they're probably rejecting claims far too strictly. If it's above 100%, well, they're currently paying out more than they collect. While they can sustain that with deep reserves for a bit, 70 to 90 is the perfectly healthy middle ground for a sustainable, fair company. Let's move to and see how this builds into your final, easy action plan for buying online today. Step 1. Compare plans on aggregators like Policy Bazaar or Ditto, or just go direct to the insurer's website. Step 2. Fill out the proposal form. Step 3, and this is highly critical, honestly declare your entire medical history. If you hide a condition now, your claim will almost certainly get rejected later. Don't do it. Step 4. Pay the premium. And Step 5. Complete a quick eKYC online, and your policy is issued instantly. We've covered a tremendous amount of ground today on this explainer, but I want to leave you with this final vital thought. If a severe medical emergency struck your family tomorrow morning, would your current insurance truly cover the final bill, or would it leave your hard-earned savings dangerously exposed to that 15% medical inflation? Your health and your wealth are deeply connected. Don't leave either one to chance. Take the time to evaluate your armor today.